Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Robert P. Kinzer.
And I'm Thomas Doty.
And we are the FITT Show, helping our people get their finances in shape. Dote, it's a great day in the world of financial education. This is our 178th show. That's something that we've been rolling, man, and we haven't duplicated a subject. We may have talked about some things, repeated some things different, but not each topic. That's been 178 different topics, though. That's pretty impressive, I must admit. Little maintenance or administrative duties here. We just want to make sure we give you a disclaimer that we are not fiduciaries. We're not licensed stockbrokers or financial advisors, but we are financial educators, and we hope you get a lot of information from us. Our disclosure is we get all of our information from Kiplinger, Fidelity, Vanguard, Wikipedia. We get a lot of information from reliable sources that we use here and repeat that information because it's good source information. So we just want to give that disclaimer. This is Thursday, the 12th of December. Man, Dope, the year is almost gone.
That's for sure, man.
But there's still a lot more to talk about before the end of the year, and especially going into the new year. Hope y'all are getting your financial resolutions together for the new year. Just want to remind you, please click on the like button and the heart button. That helps us get a lot more traction, meaning more exposure to people on the space out here in social media. And also we'd like for you to place any comments or opinions you have, especially if it's something we're talking about that you have a question about, or you have an opinion about it, or you have another topic or something that's been on your mind all week. Put it in the comment box. It's our way to interact with you. We're in a virtual studio. Doty is in Virgin Islands today. You lucky guy, you.
And 82 with a slight breeze.
And I'm in Bowie, Maryland. So welcome to everybody around the country and around the world. So without any further ado, just want to for people who missed last week's show, is tips for surviving the holidays. There was some great tips that we collected out there, and a lot of people was telling me they really appreciated them. So, and you can catch any of our shows, past shows. Not at least we go out for about a year from today. That's the capacity we're able to hold on StreamYard, which we on. But you can go, I think, far back as at least more than a year on YouTube and catch a lot of our episodes. So if you missed any of them, please feel free to go out there and check them out, you all. All right, Dope. Let's get into one of our favorite topics at the start of the show. How's the stock market faring today, bro?
Well, it depends on what you got. I'm doing okay, my little portfolio, but the broad market, the Dow has, I think, had 5 straight losses. The overall market has been
It's still at a record high of 44,000, though, right?
Oh yes, and so is the Nasdaq. Nasdaq hit 20,000 for the first time. Whoa. I want to say ever.
Yeah. I think you're right about that. Yeah, of course.
Yeah, and you can see that the S&P is actually down slightly, whereas the Nasdaq has done okay, and the stocks I hold have done really well. Microsoft has had a nice little jump. My Brady is pretty much flat, but that's because the broad market isn't doing real good. Tech stocks are doing great. Apple has still going strong. HP is still kind of flat. It's actually down 1. NVIDIA hit a bump, and it's related to what's going on in China. They're investigating. I think that's just China's payback for all the talk about tariffs on their products coming over here. So I don't really think that's going to stick around too long. So we'll see how that all shakes out. Google had a big bump. They came out with a new quantum something or other, which caused I mean, you can see their stock had a pretty healthy increase, and Pfizer is kind of staying steady down 1, and the stock I just bought. What's that? What's the next one? Last one's Plantier, right? Plantier. And
yes.
it's only up $1. That one it got as high as 80 this week, and then back off. So that again, that's another long-term play, kind of a very, very risky stock that I bought, but because I got so much in capital gains, I can afford to take a chance on a flash stock, and I'll either hit a home run and strike out. And if I strike out, I got some gains to offset that against. And if I hit the home run, I just got more money in my pocket. So that's what you can do by investing in stocks. So
hey, no, hold up here for a minute. Let's go back for a minute.
Okay.
When did you sneak HP in there?
That was a couple of weeks ago. I bought HP.
Hewlett Packard?
When I got rid of the Amazon and Tesla. And Tesla's going strong. Anybody who stayed in Tesla, you still got folks going out buying Elon Musk cars. You know anybody who bought one, Bob?
I don't know. Nobody will buy
it. But so when I got rid of those, I looked and went through the process of picking a couple of other stocks. And what I did, I looked at industries I wanted to be in. I looked to see how investment companies rated those stocks. And those were the two I came up with, Brady and HP. And I bought some more. I bought Pfizer again. I think I told you the story on that. I sold it at 30. That's one of the few stocks I had a loss on, about the only stock I had a loss on. And it was at 30 when I sold it. It dropped to 25. Actually, 24 and some change is where I got back in. And so I bought 1,000 shares of that. And the dividend is up to like 6.7%. So if it don't go up at all, I'm happy making 6.7%. But I do expect it to get some growth there too. So
hey, Dope,
that was a good buy for me. Yes,
Dope,
sir.
Do they pay dividends quarterly?
Quarterly, yes, they do.
Right.
So 6.7% on a quarterly basis.
That's a quarterly basis.
That's correct.
Not spread over for a year, divided.
No. Every quarter.
Wow, that's. I always talk about compounding dividends, though. I mean, and you reinvest them, or do you?
No, I don't. I take the cash.
So you get hit with the capital gains tax.
No. There's no capital gains tax. I get dividends, and as we talked about before, you pay a lower tax rate on dividends because they're qualified. So you only pay 15%. And of course, my marginal rate is higher than 15%. But I only pay 15% tax on those. So another reason to be invested in the stock market, take dividends, capital gains, because you get favorable tax treatment. Whereas if you got money in a CD, you're going to pay your marginal tax rate on any interest income that you have. So I'd rather get that 6.7% in dividends than even have a CD paying 6.7% because my tax rate's lower.
Right. I just want to bring attention to the people to look at the far right column, the percentage change year to date, meaning starting in January to the date. And those numbers are looking very, very well. Like you said, Pfizer is the only one, but overall, the market is doing very well. And if you had your 401k or your 403b or your thrift savings plans and stuff in the market, you're doing pretty well, though.
Yeah, I made some money this year on some of these. I think it's my best NVIDIA at 89%. Is anybody better than NVIDIA? What's NVIDIA up year to date? I can't quite read it.
Year to date, NVIDIA is up 174.
Oh, I love that. Yeah, that's really nice. Really good.
No. When did the video split?
I don't remember the date. I remember numbers.
Because that's when I got in.
You got in at about 130, I thought.
No, 120.
Yeah, okay. So you're doing okay too.
You split right at 120, right?
Yeah.
So you're doing okay in Apple. Dope. Once again, I'm sorry. What's Brady?
Brady is a manufacturing company based in Milwaukee, and I almost went to work for them back in the mid '80s. And it's a very well-run company that makes electronic identification material. They also help in efficiency projects in manufacturing, and all the analysts have them rated. I think they were rated at like a 9 out of 10, and they're expected to do well in the future. So I decided to take a shot at them too.
Well, there's the stock market, there's stocks, there's bonds, there's mutual funds, and there's cryptocurrency.
Here we go.
Cryptocurrency, though, is up 22% to $3.7 trillion
in 1 week.
And the Bitcoin is crossed the 100,000 mark per Bitcoin. Last week it was down considerably, but still, I mean, up overall, but down considerably, about a few thousand. And today, as of about 7 o'clock, it was up 28%, $2,708 up per Bitcoin. So for all those people who was like poo-pooing cryptocurrency, and trust me, I'm not telling people to do it, but a lot of people was down it. And like me and Dope said, you always should have a strategy for one. Always have a strategy for whatever you're doing in the market, whatever you're dealing with. And then if you're dealing with things that are highly speculative, like cryptocurrency, use money that you can afford to lose, and take that into account.
And Bob, I didn't put much money in, but I've got 5 times what I put in.
So when did you get in, though?
Again, I don't remember the date. It's been, I want to say, a couple of years.
Was it before or after the pandemic?
I think after the pandemic.
Okay. I got in just before. I got into 2019, and it was at 29,000 per Bitcoin, and it was projected then to go up to 100,000 by the end of the year. And as we know, it didn't.
Right.
And then I got in again at like about 55,000. And I didn't put that much. I put like 2,000, and then in the first of 29, and then 1,000 in the 55. And right now I'm up over 100%, 150%.
Yeah, and I'll take a look. I'll take a look and find out where I got in. We can talk about that next week. I can tell you the exact dates and the exact price.
But the point was, we always talked about the long play, though.
Mm-hmm.
And that's, and like you saying, y'all, we're not advising anybody to do. We just give you information. And like I said, past performance is no indicator of future returns, but we're just telling you, we've been talking about the long play on just overall, but in this particular situation, the long play is working.
Yeah, and I'm typically pretty analytical as a person, as personality, and the way I invest. But this was more of a FOMO investment, which is fear of missing out.
Me too.
And 'cause I don't really have any solid basis for having invested in crypto. There's no history that says it's going to do well. Again, in my mind, the theory of it makes sense, to have a way to pay for things without having to go through a third party. That just seems so efficient to me. And that's the reason I put a little money into Bitcoin. But again, there was no deep analysis like I would do on a stock to really find out about a company, look at what their earnings are, look at some of their financial records, and then make a decision. Crypto was purely speculative. Didn't want to miss it, and I think it makes sense in theory. That's the only reason I invested in Bitcoin.
In theory, though, with me, because everyone's talking about the dollar and how the dollar was losing its value, devaluing and going down, and they've been looking for a counter currency for some time, and cryptocurrency was cutting out the middleman. And just for everybody, just understand, cryptocurrency was what's called peer-to-peer, right?
Yeah.
So you went directly. So let me give you what peer-to-peer means. Like when you have a credit card and you have Visa and you buy something at Target, Visa was the middle person. They get 3%, even though they're charging the store, the retailer. But trust this: that 3% they pay, they charge you. That retailer is baking it back into products that sell. So what cryptocurrency is supposed to be taking that middleman out, and it's peer to peer, and it's supposed to be helping you save money and be direct. And that's the theory. And I was going with the theory though that someday that one of these coins, one of these things, are going to become actual another currency. I mean, just
Yeah,
like
you said the same thing I am. It just makes sense that there
yeah,
should be a way to pay for stuff without having to pay somebody to do a transaction. If you buy a house, why do you have to go through a bank or a mortgage company if you have the money to do that? And an even more blatant example is Ticketmaster.
right. Oh, good
They
one.
provide they provide no service, but you end up paying it could be anywhere between 20 and 30,
Right.
40%, 50% more to the price of the ticket you pay. They provide no service at all, but they really take a big hunk of your money. And so things like Bitcoin, I think might help alleviate some of those costs that really add no value.
And if I'm right though, I don't know if it's all of South America, but there's some countries in South America that's gone to the Bitcoin as
You're
currency.
absolutely correct. You're absolutely
Yeah,
correct. And
yeah.
there's some growing pains with that because if you don't have a lot of money and the price of Bitcoin goes down, you have even less money. So it's going to take a while to work itself out. But again, in theory, it makes sense.
And for those people who are conspiracy theorists about the Federal Reserve, it's cutting them out the game too. That's the other thing, because the Federal Reserve controls the interest rates and controls the money supply, and that's why you, ladies and gentlemen, when people are worried about the debt, the deficit, man, as long as we got the Federal Reserve, they will always do quantitative easing. They can print money, and that's why I stopped worrying about debt in America. I swear, when it comes
Well,
to
no, you have to worry about it because at some point it can start affecting what the government can do. But that's a conversation for another day.
that's
Yes.
econ of
Yeah.
405.
Yeah,
But
we should be concerned about the debt, but not
yeah,
overly
but
concerned.
not overly. Yeah, that's all the point I'm trying to make. So dope. Let's get into our topic. The topic of the day, ladies and gentlemen, is rebalancing your investment portfolio. Don't help everybody understand what
Well,
that is.
before you do, Bob, I just want to rehash last week's show about not going overboard in spending. This is a reminder.
Yes,
Don't
please.
do that. Don't go overboard and get all those bills in January. Then it's going to be cold in January and miserable, and you're getting all those bills for stuff you bought in December. Set your budget. Spend only what you need to spend. Take advantage of price breaks, coupons, and deals, and don't overextend yourself. Just a reminder.
That's a good one, though. Thank you for that
Okay.
public service announcement. But don't. Why is rebalancing your investment portfolio important?
It's very important, Bob, because it adjusts your asset mix so you can maintain your desired allocation. And that's going to help you align your investments with your goals. Okay. The benefits of rebalancing that helps you manage your risk, helps you control your risk. So if, for example, one part of your asset has grown and the other part hasn't, then you can do some adjusting to make sure you stay where you want to be. Keep your relationship between risk and reward where you feel you need to be. That's going to make sure you are making the amount of money you make and not absorbing any more risk than you're willing to take. Okay. And so if for example, let's just say I only owned Nvidia and some bonds and I wanted to keep a certain ratio, I'd have to do some adjusting to make sure I kept to the financial risk that I'm willing to take. So it's very, very important, Bob. Everybody should do it, or you could end up in a very, very uncomfortable situation.
And dope. I know everybody who's been on this show with us for a long time. We always talk about diversification. Diversification. Don't put all your eggs in one basket. Well, rebalancing is it's important for diversification. for definitely rebalancing a portfolio is one of the ways in which an investor can pursue also diversification. Because over time, the performance of different assets can change, and it can cause your portfolio to drift from its original allocation. And that drift can expose you to unintended risk or reduce your actual potential returns. So by regularly rebalancing, you align your investments with your financial goals and your risk tolerance. So Dope, let's kick it off, man.
Okay, and let's take a step back first. So you're looking to invest. You come up with your risk tolerance of how much risk you're willing to take, balanced by what kind of reward you're trying to achieve. Okay, and so you do that at the beginning of this process, so you know where to put your assets, where you want to invest, whether you want to be in stocks, whether you want to be in bonds, whether you want to be in fixed instruments. Again, stocks are going to have the high reward, fixed instruments are going to have the lowest reward. So you want to be somewhere in that range. You don't want to be totally all risky, and you don't want to be totally conservative because your rewards don't be there. So let's pick a common asset allocation. And that's typically 60% stocks, 40% bonds. And so over time, as asset values fluctuate, that might push your stock value to 70% of your portfolio, and your bonds are only 30. That's a little more risk than you're willing to take. So you need to rebalance by selling some of those stocks and putting that money into bonds. That's going to keep you able to sleep at night because you're back to your 60/40, you're comfortable with where you are, and you do this to manage your risk. And also, it's going to make sure you stay on pace for hitting your goals. For example, if the stock market goes down, and let's say it drops to 50% and your bonds are up to 50%, in that case, you might want to take some of that money out of bonds and put it in stocks because you're going to get a better reward in stocks. So rebalancing does that. If you do it at the right time or whenever you decide to do it, it's going to make sure you stay aligned with your goals.
So I want to talk briefly about the benefit of portfolio rebalancing, because a lot of people think this doesn't apply to them. I know a lot of my friends who are in the thrift savings plan, the government 401k plan, and they just put it in the G fund, which is the lowest risk fund and the lowest return fund, because they didn't know what else to do, or they risk averse, they're afraid, they don't understand the market, they don't understand asset allocation, and they just leave it there, man, and they miss out on so many great returns. But that's why regularly rebalancing your portfolio offers so many other advantages, which you can improve, your asset growth. And I just want to talk about one of the benefits, and that's risk management. You talked about it, leading into this, Dope. That's a big one because most people are risk adverse. But regularly rebalancing your investment portfolio can help you manage risk effectively. As different asset classes, such as you mentioned, though, equities, bonds, equity stocks, bonds, cash, perform differently over time. That portfolio initially has a balanced risk level, and it can shift to very risky, or it could be too conservative, more than you intended to be. So rebalancing helps restore the original asset allocation that you planned. Like we always talk about, you should have a strategy, have a plan, and stick to it. But sometimes you need to rebalance, and this keeps the portfolio risk profile in line with your preferences, right? So try trimming back investments can have that have grown disproportionately, and rebalancing reduces the chance of any overexposure to higher risk assets and provide a more consistent approach to managing the market uncertainties.
Yeah, and see, it also supports a disciplined investment approach. It gets you away from emotional decisions during periods of market volatility. And it can, in which case, that's going to undermine your long term goals. It involves systematically adjusting your allocations based on a predetermined strategy rather than just reacting impulsively to market swings. Things are bad, you want to sell. Things are things are high, you want to buy. That's not the way you ought to do it. This practice encourages the habit of selling high performance assets and buying those that are underperforming. And what that does, that leads you to buying low and selling high. It's enforced this discipline enforced by rebalancing prevent you from chasing short-term gains or panic selling during downturns. That's going to keep you on path to hitting your goals and making sure you are on pace to hit your financial objectives.
I know y'all have heard from us a many times talking about the term the long play, long term. So rebalancing actually enhances your long term performance, and it's another benefit which periodically reviewing and adjusting your asset allocations as an investor, you can ensure that your portfolio reaches its optimum growth. Now, although frequent rebalancing doesn't guarantee high returns, but it can improve your overall risk, depending on what your risk level is and your risk adjusted return. But constantly managing risk and seizing opportunities. This is the key, presented by undervalued assets, right? Which you can rebalance, and those who might have been undervalued, they start growing more. You might can rebalance and shift from the ones that are not performing to the ones that are performing. And this approach helps smooth out the highs and the lows of portfolio returns in the long run. And this also contributes to a more stable and a more profitable income in theory.
Yeah, and your goals are going to change over time. If you might be saving for retirement, you might be saving for college, or any long-term aspirations that you have. Okay, so rebalancing is going to help keep your portfolio aligned with those changing goals. For example, as you approach retirement, you may want to get out of that 60-40, 60 stock, 40 bonds, and you may want to go more towards 40 stocks and 60 bonds because you're going to be needing that money in the short term. That's just an example because we've talked about before. You don't want to get too conservative as you get old because most people are living a lot longer than they have in the past. So maintaining your alliance with personal financial goals helps provide a smoother progression towards achieving your goals.
So we got to remind you all, money is constantly moving. Even when you sleep, money is moving up and down. So to better adapt to market changes, rebalancing really helps be consistent because it constantly, the market is constantly changing, constantly evolving. And as an investor, it's good to adapt to rebalancing, to these changes. And the more you do, the more effective you become. Now, asset classes move differently in response to interest rates, economic growth, global events. Rebalancing takes advantages of shifts in valuations, right? Like I said, some might be undervalued and they're doing better. The ones that were supposed to be overvalued, may be doing worse. So when certain investments underperform while others outperform, rebalancing involves strategically reallocating those funds to better put those assets in position to give you better growth. And it potentially captures, the value in the downturns.
Okay, so we've talked about what rebalancing is, and let's talk about how you do it. And there's three basic strategies for determining how you do this rebalancing. The first one is calendar based. Okay, this approach involves setting specific dates to review and adjust your portfolio regardless of market conditions. Okay, you might do this quarterly, semi-annually, or annually. And this is straightforward, can help investors avoid any emotional decision making that often accompany uh, volatility. Okay, it's kind of simplistic in nature, and that's the major advantage of it. And so, if you sit to a set schedule, you can systematically review your portfolio at specific times and make any adjustments that you need to make. And it also allows for easier planning and can help in managing transaction costs as rebalancing occurs at predetermined times. Okay, and it has this drawback it may not be responsive enough to specific market measures, okay, or market movements, because something, things can happen really, really crazily. You may need to do this more often than, say, semi-annually or even quarterly. So that's one disadvantage of it. The other one is threshold-based rebalancing, okay? This also known as percentage of portfolio approach. This triggers rebalancing based on specific deviation thresholds. So instead of rebalancing at set intervals, you adjust their portfolios when asset allocations deviate from their target by some predetermined percentage. For example, if you say you're 60-40 and your stocks drop to 50, that might force you to do a rebalancing. And this one is more dynamic than a calendar base as it responds to actual market movements and the performance of individual investments. Okay, by rebalancing only when necessary, investors reduce transaction costs, minimize the impact of taxes, particularly in taxable accounts. The threshold-based approach can also help investors maintain their desired risk level more accurately as it quickly addresses any significant deviations. Okay, it requires more active monitoring and management than a calendar base, and that can be time consuming. Everybody's real busy, and frequent trading could also result in higher transaction costs. So those are the downfalls of doing it. And you have to understand what's going on in the market in order to do it based on threshold. So that one might be more suitable to the experienced investor. And finally, we have the constant proportion portfolio insurance. But that's a lot. Say that real fast 5 times. Okay. That's a dynamic rebalancing strategy that aims to provide downside protection while allowing for potential upside gains. Okay. It works by maintaining a constant proportion of the portfolio's value in risky assets like stocks and a safer asset like bonds to assure a predetermined floor value, which is the minimum value that the portfolio should not fall below. Okay? This strategy involves regularly adjusting the allocation between the risky and safe investments based on the portfolio's current value and the distance to the floor. It's designed to offer a balance between growth and capital preservation, making it suitable for investors who seek to protect their investment from significant losses, but still participating in the market gains. The big drawback of this is the cost associated with frequent rebalancing. There is a cost to rebalancing. This one requires more. This strategy requires continuous monitoring, regular adjustments to the asset allocation, which can lead to higher transaction costs also, and potential tax implications. Its reliance on maintaining a floor value may result in conservative asset allocations during prolonged market downturns, limiting the potential for recovery and growth when market rebounds.
Dope, that was pretty good. You did all 3 of those. I'm thoroughly impressed. I want to talk about let's talk about the costs, rebalancing costs, and the taxes involved, right? Rebalancing can involve many costs, and these can include transactions fees for buying and selling, like brokerage fees, as well as potential opportunity costs that you could be a trade-off. For instance, selling high-performing securities to restore your target allocation, you might miss out on further gains if those assets continue to rise. However, by including rebalancing as a part of your investment plan, you can anticipate those costs and weigh them against the benefits of maintaining a desired allocation. It just depends. Now, frequent rebalancing can incur transaction costs and potentially trigger capital gains tax, which can eat into your returns. Now, it's essential to weigh those costs against the benefits of rebalancing, like using tax advantage accounts like ours for frequent rebalancing activities can help mitigate some of these current tax implications. Now, capital gains taxes are one of the most significant costs pertaining to rebalancing. Now, when you sell an asset for more than you paid for it, hey, you realize the capital gain, which is subject to taxation. The assets held for a year or less are subject to short-term capital gains, and that's going to be hit at your margin. You're going to be taxed at your marginal tax rate, which is typically higher than the long-term capital gains tax applied. Short-term gains are taxed at your ordinary income tax rate, so that's why it's important to hold them as long as you can, at least over 12 months, and that long-term benefits, reduces your rate. Now, you could use tax advantage accounts in conducting rebalancing with 401ks, IRAs, and they avoid capital gains tax. But these gains will be taxed at regular income tax rates if you withdraw them.
You're
Now,
deferring the tax, right?
you defer the tax, but if you withdraw them out, you're going to have hit with the tax immediately and pay a penalty if you're not within 59 and a half, the extra age. Now, there's also transaction costs. I talked about brokerage fees. Now, every time you buy or sell security, your broker may charge a fee. This is the downside of rebalancing, and if you constantly rebalancing, these fees can add up. So be aware that those fees can be can add up very quickly.
And Bob, to that point, you should make sure you're using a discount broker if you are making those transactions yourself. And again, we've talked before about how to make sure you're minimizing those brokerage costs. If you are going to make a bunch of transactions, you make sure you're using a discount broker, especially if you're doing it yourself. And if you're using an advisor to make those transactions for you, you might want to pay, instead of by transaction, you might want to pay a specific fee or a percentage of your assets so you won't get caught up in paying those costs. Now, so we've talked about what rebalancing is. We've talked about the different types. We've talked about the costs associated with it. The final thing we want to talk about is the practicality of how often should you rebalance. And that's going to depend on your own individual investment goals, what your risk tolerance is, and your financial needs. Long-term investors who prefer buy and hold, they may choose to review and rebalance less frequently. Okay, they may do it annually or semi-annually. They may work through their investment advisor to determine what to do it. But by the same token, if you have shorter term goals, and you might consider rebalancing much more frequently. You might even look at quarterly. Some people might want to do it monthly if there's a lot of movements in the market to ensure they stay aligned with their objective. But again, you have to start at the beginning, know what your goals are, know what your risk tolerance is, understand how much you know and how you can react to what happens in the market, and that's going to determine how often you rebalance.
So bottom line is, quite frankly, rebalancing is about a disciplined strategy. And we always talk about having a goal, having a financial plan. In other words, having a strategy. And that's what rebalancing helps you with, the discipline, and it helps you maintain your desired asset allocation. It helps you manage the risk and optimize the returns over time. Now, by regularly, and a lot of people don't tend to do this, but it really can make a difference on the return and the performance of your portfolio. Because regularly adjusting your portfolio to its target mix, you can navigate through market fluctuations and more effectively stay aligned with your financial goals. Now, whether you choose a calendar base like Dodie talked about, threshold, or a combination of both, rebalancing requires careful consideration of costs, tax implications, and market conditions. It is so important to be understanding about rebalancing because of the difference. We showed you charts before. You can miss out on a lot of the returns that the market has if you just have your portfolio not aligned with your goals and not aligned with the risks that you're willing to take. So with that, though, that brings us, that was quite a few bit of information in 40 minutes, man. And if y'all have any questions, please put it in the comment box because that's a lot of information. But I hope y'all do understand it. And it doesn't take, you don't have to have a degree in finance to understand some of the basics of just managing your portfolio. And what we always talk about the bottom line is you want to maximize what you have.
Yeah, and Bob, you've talked about people who have their money in extremely conservative uh, investments, and that's okay if that's where you are. But we always, and again, we're not telling you what to do or advising you what to do. We just want you to be aware of the gains that are available on the stock market. And if you are planning on building wealth at a rapid pace, you won't do it with checking account interest rates or savings accounts interest rates at banks. You will barely keep up with inflation. And in most cases, you will actually lose purchasing power because you will be behind inflation. We want you to take the time to look into investing in the stock market or even some of the other alternative investments like real estate or uh, commodities, gold, silver. Those things are all doing very, very well. And the good thing about having money in different things, as Bob mentioned earlier, is diversification. Typically, everything doesn't go down at the same time. If stocks are going down, usually bonds are going up, or commodities are going up, or real estate values are always going up, depending on where you are. So we just want to put this information out here for you to consider. It may not be for you, but a lot of people have made a whole lot of money in the stock market, self included, Bobby included, and Bob's way more conservative than I am, but still made a whole bunch of money. At least consider it, because you will not get wealthy by just by just investing your money in banks or putting it under the mattress, as some people do.
And I just want to make this point, though, this last point, to so that you can see it, because sometimes we need to see it. Say you're getting a 8% return. See, the name of the game is you want to get the most for your dollar. You want the purchasing power of your dollar to work in your advantage. So just say you get an 8% return, right? And inflation is 3%, right? So that automatically cuts it down to 5%. And if you're in a 24, 25, or 24%, let's say take a quarter off of that, and you're down just making like 3%, maybe 2%, but you're thinking you're getting 8%. That's why we keep talking about other ways to maximize the return on your money, you all, because just sitting there on your money is losing value, purchasing power. And when you got more years and you look around in 10, 15 years, you thought you had a nice little money under your pillow or under the doghouse in the backyard. But I'm telling you, it'll eat through. And now they're talking about, tariffs going up and the cost of goods are going to be going up. Things on the shelf is going up. Trust me, your little savings that you have, it will eat through it. So that's why you got to maximize the amount you have. It's not about how much you have, it's about what you do with what you have. So with that, though, let's go to the summary and takeaways of rebalancing your investment portfolio.
Okay, and I think I got the first one. And what rebalancing does, it maintains your risk level. It keeps your investments at the risk level that you're comfortable with. And we always talk about that, everyone being able to sleep at night. If you're invested in things and you understand the risk and you're comfortable with that, you're going to sleep a lot better, as opposed to if you have a run up in stock value, in which case your investments are in a very risky category, you probably won't sleep as well. And so that's what rebalancing it does. It allows you to keep and maintain the level of risk that you're comfortable with.
Now, this next one, though, may sound a little tricky. Portfolio performance determines your timing. We talk about trying to time the market, which nobody does well. Not even the top financial investors in the country can really time the market. No one is really that good. But what this means, portfolio performance determines your timing. How your portfolio is performing, like if you have undervalued stocks that are doing better and value stocks that are not, then you rebalance based on the performance of your portfolio. If your portfolio is not matching your goals of what you were actually trying to get from your portfolio mix, then that should determine your timing with the market, and when you should be rebalancing. Not trying to time the market because all your friends got into a good stock and it was really, really, really paying well, and you want to jump. No, or you see that things are going down, the market is starting to tank. No, that is not the time to panic. The key is to determine what your portfolio, what your personal portfolio is doing.
Yeah. Always understand your costs. Okay. Know what you're paying for transactions. Know what the tax implications are of any decision you make and prepare for those. Again, this stuff takes some work to do, but you got to know what's going on. Know what your costs are going to be and make sure you're prepared to handle those.
And lastly, disciplined rebalancing minimizes emotions. What that means is a lot of times we get caught up when we hear the market is down and it's starting to tank, and we get emotional, we panic, or either we riding high. We got some stocks that have been doing pretty well, and you might be holding them longer than you need be. So rebalancing helps minimizes those kinds of risks that you are taking. It doesn't get rid of the risk, but it can minimize the risk. It takes out, the feelings, the FOMO, like those feeling like you missing out. All those kind of things. Rebalancing. The great thing about it, it gives you a better discipline in managing your portfolio. So with that, dope. Once again, that was 20 pounds of knowledge in a 10-pound bag. I want to thank everybody for tuning in. My sisters, all three of my sisters are on today. Am I right? Yeah, all three. Hey, Nolia, Linda, and Gloria. So good to see y'all. Rodney Madison Sr., glad to see you, Rodney, the noteexperience.com. Now, Edwards, Doty, so good to see you. We appreciate you supporting us. Garnett, what's up, Garnett? How you doing, dearest? And what's up, Joanne Skinner? Happy holidays to everybody. We want to reach out to you. No, Deborah done snuck in here on us, man. What's up, Deborah? How you doing?
Proud grandmother of twins. She's really busy.
Wow. Awesome. So look, happy holidays. And like what Doe said, remember, y'all, come on. Let's don't get into overspending. Let's get into more providing experience for somebody than providing stuff. Because 9 times out of 10, they didn't want that little funky old gift you gave them anyway.
Especially adults. Adults don't need gifts.
And look.
Adults buy whatever they want.
And don't give out none. Look, especially that fruitcake, okay? I know they accept it.
I hate fruitcake.
So don't.
And we can't close without saying, watch out for scammers. They are working full time during the holidays. Everybody's festive and happy. Don't drop your guard. Stay alert.
Dope. My friend today told me, Grant, said his grandson, he got a call from his grandson. Oh, this is Gary. I got in an accident and I broke my nose, and I'm gonna need, I gotta pay for this attorney, and they broke my nose, and then that's the message he left. So he said, "Damn, that's kind of strange." Then all of a sudden, he got a call from an attorney. Said, "Hello, I'm calling from your grandson." That's not his name. His grandson's name. Your grandson got into an accident, and he was at fault, and he's being held in the jail with $65,000 bond, and he need $6,500. They followed up with a call, though. They followed up with a call, and he said, "That's kind of," and just so happened his grandson called his daughter and was talking, and he said, "No, what are you talking about?" He had no idea.
Just stay alert. Don't answer text messages that you don't know where they're from. Don't answer emails. don't answer the phone because they have gotten really good at tricking people. Be alert. Don't spend money. Think about how happy you'll be after the holidays when you get those credit card bills and they're manageable, okay? And you don't have to worry about paying the whole year for something that you bought in December that the person probably doesn't even have by the time they get to February. So control your money.
And Dope, I'm going to leave you with the quote of the day. What is more dangerous? Someone who is not afraid to die, or someone who has found everything to live for? Have a great day,
I'm
everyone.
going to think about that one. That's a good one, though.
See you all. See you next week. Looking forward to it. My daughter, Tanisha, is getting married this weekend in Houston. Congratulations. Looking so forward to us going there, celebrating them. My first time giving a daughter's hand in marriage. So I'm getting the practice in for Melody. And we're all going there, Dope. And we see y'all next week.
And don't do like I did and not want to let go. You got to let go.
You got to let go, Dope. I know. And you've had some beautiful weddings. I've been to both of you. Yeah, well, both of your daughters' weddings. Sure have. That. Oh, man, beautiful wedding. So looking forward to it, Dope. So look, y'all, have a great time. Love y'all. Hey, love you, my sisters. We had a great time last week. See y'all next week. Same back channel, same back place. Have a great day.